The week turned on one tension: oil relief helped buyers, but inflation data did not give the market a free pass. Welcome back to this week's market recap. This is the kind of setup where the closing gains matter, but the reason behind them matters more. When oil falls, inflation pressure can cool and stocks get room. But when CPI moves higher, yields can stay firm, and when yields stay firm, equities have a harder time holding upside. So buyers now have to prove the rebound is more than relief from crude. Sellers need oil or yields to firm again. The first chart matters because SPY is where that whole risk decision shows up in the broad market. The CPI part is the problem for me this week. On June 10th, May CPI rose 0.5% month over month, and that is too hot for a market trying to price easier policy. The annual number jumped to 4.2%, up from 3.8% in April, so inflation did not just stay high, it moved the wrong way again. The headline move matters because buyers can live with slower inflation, but they struggle when the main number starts pushing higher again. Energy drove more than 60% of the monthly increase, and that is exactly why oil matters so much for this tape. Gasoline rose 7.0% in May and 40.5% from a year earlier, so this hits consumers directly and can keep inflation expectations sticky. Shelter rose 0.3% month over month, while core CPI rose 0.2%, so the quieter core number helps a little, but it does not erase the pressure. The chart makes the trend obvious. Headline CPI climbed from 2.4% in February to 4.2% in May, and that is a fast move back into a tougher market setup. These CPI data were obviously not good for stocks because they put inflation, oil and energy prices, rates, and Fed flexibility back in the way. The Dow Jones Industrial Average gained about 350 points, and that tells you the rally had broader participation than a narrow tech-only push. The S&P 500 added about 0.5%, so buyers were holding the broad market instead of giving back the oil relief move. The Nasdaq Composite rose only modestly, so growth helped the tape, but it did not carry the whole session by itself. VIX fell hard into the high teens, so fear backed off, and that gives buyers more room as long as price keeps holding. Bitcoin rose slightly near 64,000, so speculative demand joined the move a little, but it was not leading the risk trade. If SPY holds this rebound while oil stays contained and volatility stays lower, buyers keep the first shot. If yields firm again or crude snaps back, we have to treat the S&P 500 weekly pulse as the real test. The S&P 500 still has a bounce path, but momentum already gave the warning before price rolled over, and that warning has now followed through. MACD divergence is the pressure point here. Price made a higher high while MACD made a lower high, and since that second pivot, SPY has already pulled back about 5% over 8 bars with lower short-term lows. That shifts this from early caution into active downside follow-through. I warned in the June 3rd daily update that fading momentum could turn the rally into a pullback test, and that is exactly the risk now on the table. The oil relief helped buyers late in the week, but the hot CPI and PPI data keep the Fed pressure alive, so bulls need MACD to stabilize and price to reclaim higher ground before I trust a stronger push. Now the trade decision is simple. This still looks more like a bounce zone than a full breakdown, but buyers have to prove it by the close. Price is still above both the 50 days and the 200-day moving average, so the broader structure has not broken yet. 50-day support has held for 47 sessions, and that gives buyers a real cushion if this pullback stays controlled. Support line has been active for roughly 37 sessions, and price is still testing it rather than breaking cleanly. RSI is back around the 50 line and turning up, so downside momentum is no longer clearly backing a breakdown. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling instead of accelerating. If this support area holds, the cleaner path is a bounce back toward the middle or upper side of the structure. If buyers lose it on a real close, the bounce story gets damaged fast, and QQQ has to prove tech can repair the tape. QQQ is the leadership check after SPY, and the first message is not a clean green light. Tech has stabilized, but the earlier momentum warning is still active. MACD divergence is already working here. Price made a higher high, while MACD made a lower high, and since that second pivot, QQQ has already pulled back about 8.3% over 7 bars with lower short-term lows. That means this is no longer just an early caution signal. Buyers need MACD to stabilize and price to reclaim higher ground before I trust Nasdaq leadership as a real engine for the broader rebound. Oil relief helped growth stocks breathe late in the week, but hot CPI and PPI keep the rate pressure problem alive. If yields stay firm, QQQ can bounce, but it has less room for sloppy follow-through. The actionable setup is the support test. For me, this still looks more like a bounce zone than a clean breakdown, but buyers have to defend it. Price is still above both major moving averages, so the larger QQQ structure has not rolled over yet. 50-day support has held for 47 sessions, and that is the first cushion if this tech recovery is going to stay alive. Support line has been active for roughly 46 sessions, and price is still testing it rather than breaking cleanly. RSI is above 50 and rising, which keeps the short-term momentum picture constructive for buyers. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling instead of accelerating. If this support area holds, the cleaner path is a bounce back toward the middle or upper side of the structure. If QQQ loses it on a real close, tech stops helping SPY and the next chapter on yields becomes the pressure test. Yields are the pressure point after QQQ, because tech can recover only if rates stop leaning against the trade. Golden Cross is still active on the 10-year yield, with the shorter average above the longer one for 54 days, so the rate trend has not broken. SMA 50 is still rising, and that keeps the shorter-term yield trend supportive for rate buyers. SMA 200 is also rising, and yield is still about 6.6% above it, so this is still a firm long-term rate structure. Current price is elevated enough that equity bulls do not get a free pass here. I warned in the June 3rd daily update that firm yields could pressure growth, and that is still the issue now. Hot CPI and PPI keep the Fed boxed in, so if yields keep holding up, the broader stock rebound stays conditional. The tactical question is whether this is a yield-bound zone or the start of real relief for stocks. Price is still above the key moving averages, so the chart is not acting like a confirmed yield breakdown yet. 50-day support has held for 66 sessions, and that makes this area important for the next rate move. Support line has been active for roughly 72 sessions, and price is still testing it rather than breaking cleanly. RSI has reclaimed 50, so momentum is shifting back toward yield buyers. MACD momentum is fading below zero, so the chart still needs price confirmation before I trust a stronger yield bounce. If this support area holds, yields can bounce back toward the middle or upper side of the structure, and that keeps pressure on SPY and QQQ. If support breaks on a real close, risk assets get breathing room, and crude becomes the next big inflation input. Crude is the inflation pressure valve after the yield chapter, and the late week drop helped equities because it took some more premium out of the tape. Golden Cross is still active, with the 50 days above the 200-day for 69 days, so the bigger oil structure has not fully flipped bearish yet. SMA 50 is flattening, and that is the warning. Upside momentum is fading even though the prior cross is still in place. SMA 200 is still rising, so I treat this as consolidation risk inside a broader oil structure, not a full long-term reversal yet. Current price is down near the mid-80s, and that matters because lower crude gives yield some room to breathe, while any fast reclaim would bring the inflation problem right back. The trade path still leans rejection first, but I'm watching for a turn because oil has already fallen hard into the lower side of the structure. Price is below the 50 days moving average but still above the 200-day, so the short-term picture is softer while the bigger trend has not broken. 50 days moving average is the first reclaim level. Until crude gets back above that area, rallies can still get sold. 200-day is the deeper floor, and staying above it keeps this from turning into a full trend failure. Support line is the downside checkpoint if sellers keep pressing crude lower from here. Resistance line is the upside test. A clear reclaim through that structure would flip the setup away from rejection and back toward recovery. RSI is still below 50 and fading, so momentum has not repaired yet. Price is already at a lower low while RSI is still above its prior trough, so a bullish divergence may be forming, but I need price and RSI to turn up together before I trust it. MACD momentum is fading below zero, so crude still needs price confirmation before I call this a real bullish turn. If oil stays weak, inflation pressure eases, and that supports the broader stock rebound. If crude snaps back through reclaim levels, yields confirm again, and Nvidia has to carry leadership under a tougher macro backdrop. Nvidia is the leadership test after oil, because lower crude helps the macro backdrop, but the AI trade still has to prove buyers are willing to step back in. Golden Cross is still active, with the 50 days above the 200-day for 242 days, so I am not treating this as a broken leader yet. SMA 50 is still rising, but price is now trading below it, and that is the short-term problem buyers have to fix. SMA 200 is still rising underneath, so the long-term AI structure remains intact unless sellers start pushing much deeper. Current price is below the shorter trend line, which makes this a correction inside an intact uptrend, not a confirmed trend reversal. So the bullish side still has an argument, but it needs a reclaim. If Nvidia cannot get back above the 50 days area, AI leadership stays in repair mode instead of driving the whole tape. The tactical setup is a bounce zone, but not a free pass. Buyers need to prove the support reaction has real participation behind it. Current price is near the lower end of the support and resistance structure, so this is where I want to see buyers defend the AI trade. 50 days moving average is just overhead and acted as resistance today, so that is the first reclaim level. 200-day remains below as the broader trend floor, and staying above it keeps the larger structure from turning defensive. Support line is the area that decides whether this pullback stays controlled or starts turning into something heavier. Resistance line is the upside test if buyers can get the bounce going. A reclaim back into the upper structure would repair a lot of the damage. RSI is near the 50 line, so momentum is balanced rather than clearly bullish or clearly bearish. MACD is still slightly negative, but the histogram is improving, so selling pressure is cooling rather than accelerating. Volume overlay is the caution flag here. The 5 days average volume is in the bottom 20%, so participation is unusually light for this chart window. If this area holds and NVDA reclaims the 50 days, the broader market can keep treating the pullback as corrective. If it fails, AI leadership weakens, and Meta becomes the next test of whether AI spending is still supporting valuations or pressuring them. Meta is the weaker mega cap after Nvidia, and that matters because AI spending scrutiny is not giving this stock the same leadership support. Death cross is still the regime here, with the 50 days below the 200-day for 127 days, so the longer trend remains defensive. SMA 50 has stayed below the long-term line, and the recent 2-day push above it did not hold. SMA 200 is still declining, so buyers have not repaired the bigger trend backdrop yet. Current price is back below both major moving averages, and that confirms the bounce was counter-trend rather than a lasting reversal. For the broader market, that pushes against the bullish case. If Meta cannot reclaim these moving averages, megacap tech is not giving SPY the same support that Nvidia still might. The tactical setup is still bearish first. Support can weaken the downside story if it holds, but right now sellers still have the better argument. Price is below both major moving averages and trading near the lower end of the current structure, so the backdrop remains defensive. Support line is the key decision area. For me, support still looks vulnerable, and continuation lower is more likely than an immediate bounce. Resistance line is the reclaim test if buyers do respond. Without a pushback toward that upper structure, the bearish setup stays in control. 50 days moving average is overhead now, and that makes any bounce fight resistance before it becomes useful for the bull case. 200 days moving average is also overhead, so the larger trend still needs real repair before I treat Meta as a stabilizer. RSI is trying to recover toward 50, so downside momentum is easing, but it has not fully repaired. MACD momentum is fading below zero, so price still needs confirmation before this becomes a bullish recovery attempt. If support gives way, downside continuation is the cleaner path. If support holds and price pushes back up from here, the bearish read weakens quickly, and then the economic calendar becomes the next market test. Now the calendar is where the whole setup gets tested. After Meta showed more weakness under the surface, the market needs macro help, not another reason for yields to stay firm. Wednesday, June 17th is the big day, with retail sales, the Retail Sales Control Group, the Fed interest rate decision, the policy statement, the FOMC projections, and the press conference all stacked into one session. The retail sales numbers test the consumer side first. If spending comes in hot, the market may see stronger demand, but it can also keep inflation and yield pressure alive. If retail sales cool in a controlled way, buyers get a better argument that demand is slowing without breaking, and that gives stocks more room to treat pullbacks as corrective. Then, the Fed decision and statement become the main pressure point. The rate estimate and previous rate are both 3.75, so I care less about shock value and more about tone. If the projections or press conference sound worried about inflation after the hot CPI and PPI week, yields can stay firm and growth stocks can stay under pressure. If the Fed sounds steady and does not push back too hard against risk appetite, buyers get more room to defend the broader uptrend. So the two-path setup is simple. Control consumer data plus a steady Fed helps the bounce case, while sticky inflation pressure, firm yields, or weak demand keeps the retest risk alive into the next tape. The full market read is still bullish enough to respect, but not strong enough to chase blindly. Again, the market held the broader uptrend, but the close now matters more than the intraday push. The overhead resistance cluster around 745 is the first line I care about, because price is close enough to press back into that area, but buyers still have to prove control there. Again, price can keep pushing higher, but I would not blindly chase it into that resistance zone without a firm close. RSI at 52.9 is not extreme, so the market is not washed out and it is not overheated in a classic blow-off way. That helps the bullish argument, but it also means momentum still has to turn back up instead of drifting sideways. MACD is rolling over while still above the zero line, so the trend is not broken, but buyers have not fully repaired momentum yet. The upper Bollinger area is still part of the next upside test, and that means a push can work, but it needs acceptance, not just a quick tag. ADX at 26.5 still says the trend has strength behind it, so I'm not treating this as a failed market yet. Again, the macro driver does not replace the level. Hot CPI and PPI keep the Fed problem alive, while lower oil gave buyers some relief. That combination makes the next close important, because if yields stay firm, stocks have less room for sloppy follow-through. In the June 3rd daily update, the warning was that buyers needed to prove the move through the close, and that is still the right lens now. From here, I am moving this into the thesis map for the next tape, because the decision is no longer just direction. It is whether buyers can hold the right zone into the close. The path I would give the edge to is still controlled continuation, but only if buyers hold the current breakout structure and press back toward the 745 area without fading. The overhead resistance cluster around 745 is the line in the sand for that first push. If buyers push into that area and do not get sold right away, the move can keep working toward the next upside test. The secondary resistance cluster around 760.4 to 764.2 is where the next real supply test sits. The upper Bollinger Band near 764.2 makes that zone even more important, because it is where strength can turn into stretch quickly. If buyers can keep control through that higher resistance area, the larger upside objective only starts to come into view around 826. Again, that target is not active just because it exists. It needs a confirmed hold and follow-through above resistance. If that first push fails, the risk alternative is a cool-off first, with price pulling back toward primary support around 724.6 before buyers get another cleaner chance. Primary support around 724.6 is not automatically bearish if buyers defend it cleanly. If buyers lose the breakout structure around 745 instead of holding above it, the bullish read weakens fast. Again, as long as buyers keep holding that structure, pullbacks are corrective first. Below it, the market has to reset before I trust the next push. So the final question is simple. Do buyers hold 745 and press toward 760, or do we cool off into support first? That is the full weekly market recap for June 8th through June 13th. Watch whether buyers can hold the 745 area, respect the 724.6 support risk if the tape cools first, and let the close confirm the next move before chasing. Thanks for watching, stay sharp, and I will see you in the next market recap.